because first of all, Fed is rich right now, and also want the Fed to listen to them. So that's why Fed had a fighting too. Okay. So a lot of things in this struggle, but however, right now we're getting better. It means like the Fed right now pretty much normal. They know they build up the DNA. It is independent. They all trying to figure out how to do the independent way. Okay, so that's what it is. Fed. Just give me some idea about this fighting situation. Okay, so now independent for European. First of all, understand our Fed system, okay? Our Federal Reserve Banking system, how that works, have board of directors, have districts, have independent set up that way. All 12 districts, those banks, they incorporate separately. So each one independent, okay? And they have vote something. So you understand the US, this central bank system. Our US central bank is Federal Reserve System, okay? But the other European is much more easier, is they by country, okay? We are one country by 12 districts. They are European, it's by country. So obviously they will be independent, okay? Let me give you the story regarding to European and ours, the US Federal Reserve System, how independent play differently. You know, during the financial crisis, okay, so our country, we can pay out, you know, different state, different company, different corporation. The Fed just make sure that issue this, you know, helping make loans. So that's it, easy, very easy to make a decision. But in the European, when they are join the Euro or European Union, okay, they join together, but they make a decision, each country by their own, okay? So then during the financial crisis, remember they need to help other country. So because they together, they should help each other, right? But it's very difficult because each country, their own taxpayer money, you want to pay out, let's say whole European Union join the group and then help Italy. Now Italy, then other country will be saying, no, we don't pay out them because they're not, you know, it's the other country. Your taxpayer will be unhappy. But that's how difficult it is in Europe. But in US, it's just the other state, it's within the same country, so we can easily handle it. Although they're very independent, because in Europe, they're very independent because by country. So that's, you can see the similar and the difference. But however, the rule and everything else is similar. It's not big deal. So that means for you to understand this relatively easy. So European just follow, and the Japanese central bank, other central bank, same thing. But European central bank, it is a union connected, a small country together. So a little bit, that's it. So nothing else, everything else detail, just a little bit, you know, common dates difference, like this 8 years, no renewable. We are 14 years and no renewable. Just a couple of things that's different. Otherwise, it's same structure. So you just follow that as well. That's fine. Okay. So like I said, they have their operation is similar. Okay. Just we do all those. Most of the time, it is US is leading of the central bank, because we do everything we can try, we can do, we make error, we improve. Other country, European, Japan, or Chinese, those are the central bank normally will be watching us, because we move fast. US do everything very dynamic, okay? So we do everything very fast, then they find out it works, okay? And then they will do it. So that's why a lot of things they can learn from our operations, okay? So that's what they did. So basically get some idea. So I don't want to mention too much about the European here. So just follow where is the location, where is the central bank, that's fine. So pretty much relative, like I say, it's similar, not big deal at all. I want to go to chapter 7. Okay, this is just a couple of things to touch the European things. Okay, independent they are, like I said, they are independent because they are different country. All right, but they have the point is the two independent working together is very tough for them, because they member, but then they want working together, pay out. The other country had to have a negotiate, take the time very, very slow, because the other country, not like our own country, different state, the president of the United States signing or Fed make decision, boom, there already. So they're more independent, but however, they are more difficult to working together. But still, they're working together, help each other. But some idea, like I said, right? So then you have other central bank, a lot of central banks, it's just they do the similar thing. Okay, that's it. So this chapter and the European piece, you don't need to bother that much. It's just the same logic. But understand the U.S. Federal Reserve Bank system and the function, how that works, is becoming very, very important one too. So, but it is not a big deal. This whole chapter not big deal, just a structure, organization, all right? So let's go to chapter 17. 17 is very difficult, but I want to be slow. I want to slow, and then so you can learn a lot from chapter 17, 18, and important one, okay? See, 17 is money, right? Remember we talk about money. Money, how they do money supply? How money supply, how the Fed put money in the economic system? Now we know this pandemic, we know give each person's a check. How they did that, okay? So that's actually physical policy. It's not Fed. Fed is a monetary policy. How Fed put money in the economic system, okay? So this is a little difficult, but jump in if you have question, okay, let's say. First of all, if the Fed put the money in the economic system, and you and me can enjoy it, can be used money to spending, for example, give us loan, give us program like a small business loan, whatever Fed do, it's not physical policy, okay? The pandemic, they give you PPP program, give you your paycheck, checks delivered to your hands, that one is a physical policy. Here, we don't even talk about that way. So they have to put a money system, in the economic banking way, and then you will enjoy, but you didn't touch it, you don't know. You don't even know, okay? You don't, not in your hands, that's for sure, okay? So that's different way, huh? But because of that, so therefore we needed to know who is there. So 3 players. Without single one player, we cannot see the money flow in the economic system. We need each of one. So one is the central bank. So first of all, central bank is our money system, okay? They are operation, provide money supply, okay? So that's why Federal Reserve System. Why it is that system? Because 12 districts, and within those have so many, you know now, board of directors, the directors of each banks, how they voting, those system, okay? Within this system, they do a lot of monetary policies, okay? And how to do that, conduct, that's the whole system, how they did it. And then beyond that player, you have banks. Remember, they not directly, central bank not directly working with you and me. We are depositor. So not direct, well, you're not directly working with the bank, with the Federal Reserve System give you money, you do not you directly give to you. Okay, they do with the bank. So bank as intermediaries, but bank becoming very important player because you do the bank. You go to the bank and do the deposit, okay? So banking becoming your connection, but bank connect with the central bank, okay? So that's how this is 3 players, very, very important. They all have to be here. Otherwise, this money supply will stop, okay? So because of that, let's see how that works, okay? So bank we talk about, we not talk about Goldman Sachs, okay? We not care about the investment bank. We talk about the depository institution, like JP Morgan, right? So those direct link to the depositors, okay, you and me. And that's the, if you can deposit in the credit union, deposit in the SWIFTs, those banking, that is a depository institution, okay? And those banking is important, we are talking about here. So that's banking, okay? And then depositor. So you and me, okay? If you don't do banking, you're holding cash, you don't have business regarding to here, okay? Only those people who deposit in the banking, withdraw, deposit, do business, banking business or small business, those link, so that will have an effect on money supply. And so that's why it's part of the player, okay? So that's individual and institution, okay? So that's the 3 player to involve money supply. So let's see how that works, okay? Very important, follow me, okay? So we know, we learned before, we learned the banking's balance sheet. Remember, so any entity have balance sheet. Banking have balance sheet. We learned that before, and we learn a lot about managing the money from the banking side. So now we talk about Fed. The Fed is a bank of banks. Okay, they are banks, but remember I mentioned about this many times. Fed is a bank of banks. So all those member banks, okay, so they link to the bank. Okay, so Fed is so linked to the Fed. So Fed is the banking, okay, it's a bank, but just only the special bank. They can print money bank. Anybody else cannot. This bank is special, okay? So that's why it's a central bank. But the Fed also have their own balance sheet, okay? So that's it, because if we don't understand Fed balance sheet, we can no way understand how they print money or how they increase money supply in the economic system. You do not know how to do it. So that's it, you have to understand balance sheet, then we will understand how the Fed can provide money supply or take money supply from the economic system. And that's how this Fed balance sheet size give you information, okay? Remember I just mentioned about the Fed, if you go Fed balance sheet right now, you see already 7.7 trillion and then not down yet, right? Right now it's gonna be more. So that's why you can see the balance sheet size keep going, okay? Keep going up. All right, so let's see that balance sheet. So Federal is the banking system balance sheet. You have assets, you have liability, okay? So let's say you have assets, what they have at first one. Remember I say is Fed have so many securities. Remember securities. Fed open market, but we'll talk about open market buy, sell things, okay? But Fed have security normally is treasury security, okay? Remember our treasury want to issue bond, how our government want the money. We want the money, we issue debt, right? When we issue debt, those bond, treasury notes, treasury bill, they all selling in the market. So Fed, just like a banking, they can go to market, buy those security, okay? Then this security is assets sitting in the Fed balance sheet. That's why you saw this security. It's not like stock, okay? The Fed not buy stock, buy security. Normally, 90% those security are treasuries, okay? Let me mention, since here we are, this is secure treasury, but remember financial crisis, 2008, even right now, pandemic, okay? Fed can do special actions, which is buy not just treasury security, they can also buy, mortgage-backed security, something less liquid. The whole point is to help economy, provide more money in the economic system. That's why they buy those security and buy even more. We will mention about that, okay? But now you know Fed assets is security. Those security, treasury security can make a coupon, okay? They can make a coupon interest. So Fed make money, can seize their assets, right? This is one thing. And also Fed have loans to financial institutions. And this I mentioned it before. Remember I say is during the financial crisis, the Lehman Brothers, if they can borrow loan from the Fed, maybe they can survive, but they not qualify. So only member bank qualify. So then what do you mean qualify? It means they can borrow money from the Fed. So this loan is to the financial institutions who are members. What do you mean member? Member means the Fed, you're under Fed, then Fed will be regulating you. You had to follow the Fed rule regulations. You had to report it to the Fed, then Fed oversee you, so then they can lend you a loan. Okay, so normally it's member bank, okay? But once the Fed make a loan, imagine this loan, it's a Fed assets. So Fed make interest too, because of the borrower, they lending to the borrower will pay the interest. So they can see Fed make money in that side, okay? So they have security and they have loan, okay? So that's like a regular banking, right? Regular banking like this too. But liability side, you will see this is not regular banking, okay? Because they have a currency in circulation. Which bank have a liability print of money? No, only the Fed. Okay, so that's why Fed have. So once the Fed have currency in circulation, remember I mentioned about currency in circulation is if you have uncle in Italy and have money cash in dollar, and this currency, it is even in the Italy, but still it is our, on the balance sheet liability side is our currency in circulation. Okay, it doesn't matter where, as long as the money we print, we issued those money, and then it is our liability. Okay, so that's a liability. And the other one is reserve. Okay, I didn't mention reserve before, but reserve, remember whose money? It's the bank's money, right? So bank put money reserve. So let me go back again. I just, if you miss it about what we mentioned before, the bank is Fed is the bank of banks. Let me repeat again. So this is the Fed. So the Fed. So that means the Fed just means the Federal Reserve System. In short, is the Fed. Okay. And then you have member bank, many member banks. So that's at JP Morgan. Okay. And then you have Citigroup. Okay. And you have Bank of America. Okay, let's just say this way. So you have many banks. So those banks, it is a member. If it's a member, they have an account with the Fed. Okay, so that's the account. Let's say here's the account. Okay, here's the account, and this is the bank, the other bank. So they are, remember the Fed is a bank. So that's why those banks have an account with the Fed. Okay. So now when they have account, they have money put in here. Okay, there's some money here. So this money, they have it is reserve. Okay, we mentioned about this reserve, like a required reserve. So they have some money put in here in account, and some piece is reserve, required reserve. Some things is maybe excessive reserve, maybe more than required. Okay, so definitely you have account, you have money put in here. This is important. We're going to do this back again. Okay, so that's what I mean here. So that's the Fed. So we know the reserve. That's why it's a liability, because when you see the reserve there, it's a banking's money. It's not the Fed money. It is. That's why it's a Fed liability. Okay, so we must be clear here. Okay, otherwise we're moving around, you got lost. Let's repeat it again. Assets easy to understand because they are banking. Okay, so then that's why they can buy security. It's theirs, so they collect those coupons, and then the security is theirs, assets, and make a loans assets. Okay, liability means they are issue a lot of money, issue the currency, and those liability, because when people collect the money, go to your still collect as the bank notes. If you look at your dollar, it's said the Federal Reserve notes because they issued. Okay, remember it's legal tender, and that's what they issue the money. That's why you worry about this issue too much. We will have inflation, and this is another thing. Okay, this is one reserve, but it's money. It's the money. It's the Fed liability, but it's banking's money. Banking put in there. Remember in parking there, that's why it is the reserve. Okay, so that's the two. Like I said, it is the asset liability. Okay, let's see how that works. Follow me. Okay, it's very, very important. So we know now. Okay, so that's, I have to mention this piece because otherwise we're going to use it. Okay, so we say is monetary base. We learned that before. Okay, monetary base. So monetary base also called high-powered money, because this is becoming very, very important. Money, this is a key here. Monetary base is a key. It's a Fed control what? Fed basically just want to control this piece, okay? So high-powered money, but we want to see which piece is very, very important. So one piece, this high-power money is defined is one piece is currency in circulation, okay? The other piece is reserve, right? You just saw that's reserve. The total reserve, they call total reserve because inside we can say is required reserve plus excessive reserve. But overall total reserve, all the reserves, banking's money, okay? And this is already printed in the circulation. So all those money add together, we call it is a monetary base. All right, basically money is a basic. But this money is very important. That's why I call high-powered money. All right, just give a name here, but we're going to use this as a new definition to working on this. Okay, so that's monetary base, and then this reserve and currency in circulation, okay? So let's follow, see how that works, okay? So now remember, Fed can conduct the open market operation. Let me say it again, okay, very important. Fed provide money supply or take money back is one tool is open market operation, okay? So let's see how that works, okay? So here trying to say is one direction is open market purchase. Okay, let's say it again, okay? So Fed is a bank. They want to buy something in the open market. Okay, this is a free market, okay? An open market means it can open market buy from anyone who is, they right now Fed want to buy from bank. From bank means Fed buy from those, let's say JP Morgan, okay? They buy something. Remember the majorly it is a security, so they buy security. For example, buy treasury security, okay? So let's see, they buy from the Fed buy, what happened to the balance sheet, okay? Let's see. So the Fed buy at here. So banking system, remember, even you have just, I just list the system, it is a JP Morgan, Citigroup, and Bank of America. It could be just assuming bank system, just one bank, okay, very easy. So let's see what's happening to both balance sheet, okay? So Federal Reserve System, just assuming how one banking, okay, Fed. So Fed is buy security. So obvious security increase, okay? Follow me. So increase. So that they buy 100 million, so security increase 100 million. Remember, Fed balance sheet have to be balanced. So if assets increase 100 million, their liability also increase 100 million. So then here's liability. Remember, it is the banking's asset. They buy from the bank, okay? So bank use their money, you know, this treasury security buy the so banking, they buy the security. So Fed gave the money to the bank, gave the money to the bank. So bank is selling security to the Fed. So Fed have to give the money to the bank. So this is reserve. Let me say why it's reserve. Okay, let me show you the chart again. Okay, let's say Fed buying, Fed here, open market buy. So they buy, let's say this is buy from JP Morgan, okay? So JP Morgan have account here. So JP Morgan just, because Fed want to buy the security, JP Morgan sell the security to the Fed. Then Fed just deposit the cash, money, okay? Don't say currency, don't say cash, just money. Just put the money here. You understand? Because they have the account, okay? So when the money put in here, JP Morgan get the money, it's JP Morgan's money, but it's a Fed's liability. But in here, it's a reserve. Are you following me here? You okay? So it's a reserve, okay? So therefore, it is a reserve, but it's liability. Let me say this again. Because remember, we defined as a reserve is a Fed liability, but it's bank's money, okay? So therefore, once the Federal Reserve buy 100 million security and liability, here's an increase too, because this is becoming $100 million give to the bank who they buy from the security, okay? So the Fed balance increase both sides. Watching the bank. So this bank, they selling security, this is negative, okay? I can do it, okay, let me do it. So it's negative, okay? Because this security selling to the Fed. So the banking security dropped, gone, right? Gone, the selling is 100 million. So selling 100 million turn out becoming reserve. Okay, it's the money, but it's deposited there as a reserve, okay? So that's why banking system selling security and have the reserve net result is nothing happened because security becoming money, okay, it's reserve there, okay? So banking system, this is situation changing like this way, okay? So net result is that reserve increase because the Fed buy security. So reserve increase 100 million. Currency didn't change because nothing happened regarding to currency, okay? So because monetary base defines currency plus reserve. So now because reserve increase 100 million, so monetary base increase 100 million, okay? So here just trying to show you one thing is happening right now. it is a reserve happened, okay? Reserve increased. How we increased? Because the Fed buy security in the market, buy security. Go ahead.
So is this one way that the Fed, in this action, the Fed is essentially creating money?
Yes, that's exactly the point. That's exactly the point of how Fed put the money in the economic system. That means they want the society, economy have cash, have money. So they take security back. Yeah, they are balancing. Whole point is just create the money, take the money back, put the money more. In this case, they put the money in economic. Imagine, let's just stop here. Very good question, okay? So imagine once this Fed buy the security from JP Morgan have this money reserve 100 million. Let's go back that chart. If the JP Morgan, see, here's 100 million. Now this JP Morgan selling the security have the 100 million cash money. JP Morgan have money, JP Morgan is the bank. They won't relax there. They will use the money to make a loan. Remember, have you and me is here, depositors. That's how the money goes through from this central bank to the banking and to you. Then you and me, we all have money. Then we do business, economy booming. That's how you have money. That's because JP Morgan get cash. JP Morgan get cash because JP Morgan have a lot of treasury security sending back to the Fed. Fed gave the money. And that's how that works. Very good. Actually, they already touched so many things already, but then we just talk one piece. You already sense about what's going on now. Very good. Okay, that's the point.
Oh, sorry, I just wanted to follow up.
No, go ahead.
Can the Federal Reserve buy securities without creating money?
That's what they did. It's not that. That's a good question. Okay, they did it once. Is Operation Twist, and let me show you again. Okay, have you heard about the Operation Twist during the financial crisis?
No.
Okay. Yes. Exactly. Today I'll tell you will never forget. Okay, very good. So quantitative easing, QE 1, 2, 3, those are print money or create money. Okay, we'll talk about that. Only one thing they didn't print money is the twist, Operation Twist. How they twist? In fact, balance sheet, just like we learned banking balance sheet, you have long-term security, short-term security. Okay, remember short-term security like a TBO, those 3-month TBO, 6-month TBO. Then treasury bond security have a 30-year maturity, 20 years maturity. You have long-term security, have short-term security on UI treasury, federal security balance sheet. Okay, so twist, what they do is because that moment they did the quantitative easing 1, 2, 3. I didn't get that. Could you try again? Oh my God, sorry, my phone. Okay, okay. The quantitative easing is they trying to spend the more money in the economic system, build up the big balance sheet, and people criticize it. Then later on, we still want a happy economy, lower interest rate, but we don't want to create too much the funds or too much inflation worry. So then they trying to say, do this way, do twist. How they twist? They want to lower this 10-year interest rate. That moment, they want to buy 10-year treasury security. But then we already quantitative easing enough. We don't have that much money. We don't want it to continue to create an inflation worry. So what happened? They do this one. They're selling the short-term security, selling those 3-month TBO, 6-month TBO, use that money, billions, couple billions, and then continue buy this 10-year maturity treasury. So when the Fed will buy this price lower, okay? And then yield, so the price going higher, then yield going lower. So the yield curve will be lower. That's the whole point. They wanted to yield curve lower, help the economy. And that's this way they do Operation Twist is no cost of printing money, didn't printing. They use selling the money, just different maturity, selling this security, buy this security. So total money wash out very soon. So it's not a big deal. But what we're doing here is totally created new money. Okay, created new money because they buy from JP Morgan and then give JP Morgan money. So that's why this is security play between the banking, member banking. Remember, you learned the banking that moment we mentioned a lot how member bank require holding in their balance sheet, not a bond, not a stock at all, and not that many lower quality bond. Mainly is treasury bill, treasury security, don't have to be bill, treasury security. They required, okay? So that therefore banking will control just based on this member bank play. And you know, JP Morgan trillions dollars assets, and then those are over big. So Fed make them, those banks big, very big right now. And they are key player. Those bank, national big banks, they are key player, key member. They must be member. Fed require them must be. And so that's the whole point. And then Fed, we'll talk about more just here. We talk about this. So Fed, New York Fed, remember the last chapter, New York Fed each have trading desk. And they mainly trading with those member banks dealers, right? So they are actually the money market player because on the treasury security, because they are key, especially JP Morgan, right? They all same, but they trading a lot of treasury security with those New York treasury trading desk. And every day open market buy sell. You will learn more about the open market operation very soon. And so then just adjust this money control because each day fluctuated. If someday even international, right? If foreign exchange market tumbling, whatever, Fed make a decision, then we'll trading with them, adjust this, stabilize our dollar and the interest rate. That's the whole point they're doing this, okay? So you just see the open market purchase, buy, you haven't seen sell, then you will see whole big picture. But you get it, very good, you get it. So whole point is you have reserve, they require reserve something and then excess reserve with those member banks, and then they're trading with them. Then we'll talk about more, but at least you know how they created this money, okay? So very good, you already sense now. Let's continue to see how they did it, okay? So that's good. So you see that the federal buy the security, open market buy from the bank, and then the secure banking, Federal Reserve System security increase because they buy. But then their security dropped. They dropped, so then what did they have it now? They're selling security, it is their reserve. Because haven't used it yet, that's why I call reserve, just parking there, okay? So that's why I can see their reserve. Balance, you had balance, right? So security increases, so reserve increase, but it's liability because it's banking's assets, okay? So very good watching. So a lot of story follow from here. Let's see next one, okay? So they buy from bank. Remember, I just say buying from JP Morgan. Now, what if they buy from no bank, public, means you and me. Remember, we are the player too, okay? So that's a buy from you and me, okay? Continue. So same thing, they buying the security from you, okay? So you give 100 million, that's your hedge fund, you give 100 million, they buy from you. And same thing, what happened to here reserve? Because they buy from you, here's the case, you have a bank account, right? So you have bank account, remember. So how you buy, you have to go to your bank. So let's go back to bank. So banking, what happened is banking have a reserve, have 100 million. How come banking involved? Because you have a check account with the bank. You need to use your check account money to buy, you're selling your security. Once you're selling your security, your money deposited in the banking. Let me say it again, assuming this one is your broker account, it will be easy to understand. In your broker account, okay, you have a security and you're selling to Fed. Okay, then Fed give you money, just transfer to your account. So in your account, in your banking account, it's your asset, but it's a banking liability, because it's yours. So that's why check deposit increased. Okay, so check deposit increase, remember the rule is check deposit, it is 100 increase. For banking, it is that reserve. Remember we learned that? Whatever check having using that at that moment, it is deposit, it is a check reserve there. I hope you understand this piece, okay? So this one is because you selling to the Fed. Fed increase the security, they buy it, okay? But the reserve increase, why? Because you have account with the Fed. So that's why you're checking, you make a lot of money, you're selling it, you have $100 million check deposit in your account because it's selling the security. So for banking, immediately increase reserve. We learned this piece. So you're okay so far because you have check account, okay? So the person selling bond to the Fed deposited the Fed's check in your bank, okay? So now result is like this. Means you use your check to writing to selling this security and the deposit in your banking. I hope very soon we go to a different story, but so far, you okay so far? Okay, so I hope you're okay, right? Just remember, let's say this again, okay? Fed buy security this time buy from you. How you buy it? You buy it, you're selling the security to the Fed, and then you have the Fed check, and you go to your bank, deposit your check. So your banking change like this way. You deposit 100 million, just like before we learned, and then reserve increased. So the Fed have a balanced because your check account increase 100 million, and the Fed have a reserve, the bank have a reserve 100 million. Just leave it there for now, do nothing, okay? So that's the banking system. We learned this before, banking system, okay? And then Fed, obviously, they are buy the security increased. Then remember, use the banking check. So that's why reserve increased. It's the banking, now you're not Fed. So this is the same thing. So buy from the banking or no bank, turn out, because no bank, this person, you deposit the check to the bank. So that's why it turn out the same before. Same thing like before, okay? So you can see this way. And the banking, of course, the banking buy, so banking set security. But the end out is reserve increase, the same result, say 100 million, all right? So if a reserve increase, that means monetary base increase. Remember, you just asked about, say, create money. Yes, this is create money because monetary base increase, that means money created, okay? So what about next one? Let's do next one, okay? Just follow, and I try to be slow, okay? You ask me a question, I'll be slow, but I won't go too far, okay? Just a couple of things I will be slowly mentioning. Okay, now watching, I will come back again because when you back and forth, you can understand better. Imagine that now, okay? So open market buy the security from you. But now you make a decision differently. Okay, watching again. Okay, so Fed buy this is security 100 million. Okay, buy from you. You selling the security, but you hold it as cash. So there's no bank publish you, right? So you selling security to the Fed. So to here, when you're selling, you're holding this currency. You're holding this cash. You don't go back to bank and deposit your check. You don't. Is holding this cash, not watching. Now this time is different story. Why? Because Fed buy the security, but liability becoming money, currency in circulation. So now suddenly have a currency increase, okay? So that's what a different story. You're selling the security, you deposit banking or not deposit banking is different. Now your banking now involved, okay? You're selling it, that's it. So the person selling bonds, cash the check, and reserve will not change. No reserve here, okay? Didn't affect reserve, but currency increased, all right? But monetary base also increased, right? Because monetary base, again, we keep using that. So this time is currency increased. Money reserve are not changing, but the monetary base increased as well, okay? So different this time, all right? But both actions make it is clear monetary base changed. But this time, one is the currency increase, one is the reserve increase. What are they trying to say? I give you a hint. Here, trying to say is they try to analysis, say Fed trying to figure out what they can control. Based on right now situation, is control monetary base better or control reserve better? Based on what we have learned now. Do you
Reserves.
if you see watching, if you reserve, you see before is when they doing open market purchasing, you deposit in bank, not deposit in bank, becoming either reserve increased or currency increased. But monetary base both way increased. So based on this, can you guessing what the Fed were thinking, which one should be easy to control? Okay, I'll give a hint. Okay, monetary base, because what happened, currency and you see both way, you decided put the money in the bank and not put the bank, and you can control this currency, whether you put it in the bank or not put it back, right? Put it back in the banking, you will be affected. But if you're holding cash, then become only reserve change, currency not change. Both either changed either way, but definitely this one changed. So that means it doesn't matter what you do, deposit money in cash, holding in cash or deposit money, definitely when open market buy, Fed buy, and then monetary base definitely increase. So that means the Fed is sure this is going to happen if open market buy. But this do not know what are you going to do. So that's the uncertainty. So this is certain. So Fed have some idea now, say, okay, monetary base look like I can control better. So let's see, continue, okay, because this whole thing exercise just that you see what it is variable, keep changing, which one is stable, and then Fed can control something. Okay, they want to control, right? Remember, they want to make money, make a money supply, control the economy's money supply. That's the whole point. All right, so we done that. So let's see what's going on. What did they try to say here? We did this no banking. We did that currency as well. Let me repeat again. Okay, this time you're selling security. That's why you get the cash. You're holding the cash. So in the Fed system is they buy the security from you, so they increase security. And meanwhile, you see liability, cash increase, so currency increase, circulation increased. And that's the second result because you didn't deposit your money in the bank. Okay, this is only just different story, right? So you before the check, now it's cash. Okay, so that's different. All right, so let's just see bigger picture. Now we done this because it's a very, very important piece. Okay, we done the purchasing. Okay, so reverse a little bit. So open market operation. That's why I say open market operation. Operation means have both way, can buy, can sell. Always say open market purchase is the same thing as buy, right? Means the Fed buy or Fed sell. That's why this is called operation, because Fed can do this very quickly, use the New York Fed to trading with the world, okay? And then to make money go to the economic system or take money back from the economic system if too hot. So that's what they're gonna do, okay? Let's say to reverse sell. That's what they can reverse it, okay? So let's see the sell. So first of all, see banking system. Banking selling security, okay? So banking selling security will drop, okay? So if selling to no bank, you, okay, selling to you. So what are you doing, okay? You buy the Fed security, so your security increased. If you use currency buy, okay, you use currency buy, so your money will be dropped, absorb it. So that's Fed take away your money, give you security, take away your cash. So that's in the world, if they do this, all the currency in circulation will be dropped. Okay, so Fed security, see that the open market sell, they drop, so balance sheet shrink. Right now, our balance sheet mushroom bigger, okay? In the future, eventually we will go to this direction. We'll be shrink the balance sheet because it cannot too much balance, too big a balance sheet. Because imagine if right now too big, when we have a reading day coming, and the Fed want to print more money, already too much, then print more, that's terrible. So they have to eventually constrain, make the balance sheet smaller, like they do in this way. Make it smaller, then something happen, they can still make it bigger. Okay, so that's what they play in the balance sheet, okay? So that's why you can see Fed balance sheet smaller now because they are open market sell and security reduce it. So like I say, in the future, they will do that, okay? So it reduce the monetary base, okay, by amount of the same sell because they reduce 100 million because the currency, remember currency also piece of the monetary base. So currency dropped 100 million. So that means monetary base dropped 100 million. You saw the equation, okay? So reserve didn't change here, didn't affect the reserve, so didn't change. So that another thing tell you monetary base very consistent with the Fed open market sell or open market purchase. It's very consistent. If purchase was the Fed want to buy the security, put more money in the system. Sell is reverse. You can see when open market sell is they are, they are selling the 100 million. So reduce the balancing, and that means what? In the market, they put more security. Fed sell means market have. So then in the world have less money circulated. In this case, less money, right? So currency. So the effect of open market operation, see they mentioned operation, means both sell, right? Open market operation have both way, okay? Sell or buy or purchase, right? So both of these operations, the effect is on monetary base is much more certain because monetary base is really based on the Fed purpose. But however, is currency or reserve becoming different story depending on the player, what they do. Therefore, Fed say, you know what, I can control monetary base better. That's what the whole point proved here, okay? Are you following me here? Or you want me, let me recap a little bit here because I don't want you to lose too much because it's very easy to get lost here, okay? We said Fed balancing, okay? Now you're used to it now. Fed, only uncomfortable piece is liability. Only Fed have this way of liability because the Fed, only the banking can print money. So therefore, currency in circulation is liability, okay? Because you always, you have money, remember? Even we print too much money, we say inflation, but still it is print money. So this one you need to control, we need to control. So anyway, so this is the liability. We issue too more is our problem, right? So only the one piece the Fed can create it is the currency in circulation. The other piece, this is bank's money, okay, not Fed money. So that's why it's reserve. But the banking put the money on the Fed, that piece is reserve. So that's why it's a Fed also reserve systems liability. Assets easy to understand because the Fed, just like any other entity, can buy security. So that's a make money piece, okay? So that's why it's assets. The more they holding, they get more coupon and make a loan charge interest. So this Fed can accidentally make money, like I say, because their purpose should not be make money. The purpose not for their own make money. Okay, it purpose for do this whole thing increase money or reduce money is for economic situation. You remember they want to stabilize economy, okay? But accidentally, like right now, we have huge balance sheet, they make a huge money, okay? So that's the balance sheet Fed one. And then we introduce about say, what's the monetary base? Basically, the left side liability is monetary base. It's a high power money. This is the money, actually, it is the Fed created and how big, how small. It is called monetary base. That's why I call high power money. Currency and reserve, okay, that's the money they created. So this is called monetary base and also called high powered money. But you will see long going further, you will see the story, how they create, how they multiple, that's become a long story. Okay, we're gonna go there anyway. So that's when we give the definition monetary base, then they try to show you the Fed, this is just one tool, okay? Open market operation is just one tool of monetary policy, okay? But this policy is good one is they can reverse. They can open market buy, they can open market sell. What are we doing this both ways, showing you which one is fluctuated, which one is constant. And then you can see Fed trying to figure out which one they can control, whether they can control monetary base or they can control reserve, okay? They're trying to figure out which one. So that's why they do the couple exercise. So one is they do purchase. Purchase means buy security, okay? Open market buy, open market purchase means Fed want to buy, okay? Fed buy security. Here's the key, okay? If Fed buy security from the world, from the economy, banking, or from you, even they buy, they use money to buy, right? So that means they buy means they want to put the money in the economic system. So that's how they create the money. Okay, they put the money in the economic system. So that's how economic system get more money. That's like you and me, we all get the money, everybody happy, right? Just like right now, the stock market is happy because everybody have money, a lot of money right now. You know, one investment signal is so saving rate high or too much money in people's hands, stock market will going up because where your money go, have to invest something, have to put somewhere. So that's another indicator, okay? So same thing when the Fed, open market buy, purchase, they buy the security, so give you is the money, right? So you got the money. That's what they do, okay? So the open market buys, you can see the Fed buy the security, and then you see liabilities increase the money. This is the money, right? Give the bank is selling the security. So then banking's balance sheet will change like this. Banking security dropped. Okay, the Fed buy it. Okay, so selling the security, so they have money. So that's the money they have it. So parking in that reserve account. Okay, so that's why they have this. Fed have this liability. Reserve is banking. That's why it's liability. Okay, so that's what we learned at the reserve before. Okay. So they try to tell you the different way. If you buy from the bank, what if they didn't buy from bank? From you, remember we said it's the 3 players. They buy directly from bank. That's how that works. You maybe argue, say, what if I'm not? But if you buy from your individual, you see you have freedom. You can buy and then deposit your check in the banking. Normally, if 100 million, you really put your money in your banking, right? But then they also showing you people have freedom. So people want to buy and then selling the security and then put the money in the banking. In this case, it is, okay, selling security to the Fed. Fed got the security. And then you do not know why it's reserved, but you put the money in the banking. So once you put the money in the banking immediately increase the charitable deposit liability. It's your money, but the banking liability. So that's why banking have the reserve increased because remember we mentioned before on the banking balance sheet, so they increased the 100 million reserve. But this reserve was showing up in the Fed system because remember the banking linked to the Fed. Fed have the banking. Fed is the bank of the banks. So this reserve is the Fed, is the bank's money, but the deposit in the account with the Fed immediately just there, okay? Just there showing you that reserve increased because you deposit a check in your bank. Then next one say, what if you don't deposit? So in this case, well, you can see the reserve increase 100 million, okay? And previous one, buy from bank, also reserve increased 100. Look like a reserve, it is good control. But now because you know banking, this time you hold a currency. You can influence of this way. You see, when you buy, you're selling securities, treasury buy, okay? They buy 100, you're selling 100 million security, and then you're holding cash. You didn't go to bank deposit. Now the story is the currency increased. Okay, Fed did inject money, but this time it's currency. It's not reserve. Okay, so because you make the influence. So the Fed say they cannot control you. So it's pretty much look, but however, currency increase still is the monetary base. All right, see, it's the monetary base. So these two stories tell you, say, Fed can control this guy, but they do not know this is going to be changed depending on you, how you put your money away. So that's why I cannot easily control this two pieces, but this one easy control. So that's what the whole point exercise here, just practice, tell Fed trying to figure out, say, how Fed should control monetary base or reserve. Based on this, you have freedom to do everything, holding cash or holding check. So become a different story. So now we know that's why they say monetary base a little bit consistent, a little bit stabilized, okay? So that's what we did right now. Okay, just I do one more slide so we don't do this today. Now I'll give you a summary. So just open market purchase summary, right? See, the effect of an open market buy, okay? Just make sure you know the direction, okay? So open market purchase on reserve depends on whether the seller yield of the bonds keep the proceeds from the sale in currency or in deposit. So what it trying to say, depend on you whether you want to hold a currency or not. You hold a currency or hold it in deposit, the story is different. Okay, so that's why the effect open market purchasing on reserve on this are change differently because whether you hold a currency or not. Okay, but however, effect open market purchase on monetary base always increase the monetary base by the amount of purchasing. See, Fed know, okay, if I want open market by 100 million, I know what monetary base definitely increase 100 million. But I do not know whether it's increase currency or increase reserve, but definitely create money, 100 million. So that's why it's called high power money, because this is what we know. We create 100 million money, but I do not know if it's created in currency or it's in reserve. Okay, so that's the only thing they created. Okay, I will stop here because this chapter very important. I don't want to halfway sleepy. And then later on, you will see, I gave you a hint, is that you will see once they create money and then become a mushroom. Okay, once you know this, you pretty much will understand why so many people do not want the government to print too much money because so many worry. And now you know why Bitcoin becoming hedge of inflation, whatever. But we will talk about that in the later. But that's a flavor because it's really can hedge or not, depend on debate. But definitely print too much money, people worry, and people are becoming concerned everything. All right. So they try to do everything, try to be away from this money, could be inflation. All right. So we just stop here. Any question? The homework already set up for you, right? Hold on. What do I suppose finish? I suppose finish 25, right?
Yeah, we have 10 minutes.
I have 10 minutes. Okay, I thought I had 1 minute. Sorry about that. So 10 minutes. So, okay, then I'm going to continue a couple slides, okay? But anyway, my homework is open there. So you'll know the homework is there trying to be do the exercise before you go to the final exam, okay? So, okay, very good. Thank you very much. So this give you a hint, give you the summary. Let's continue that. We'll go back again, review back and forth, okay? So continue, you will see the more interesting, okay? So let's see what happened. They give you the summary, and now we say open market sell. So we didn't mention about the sell. This one is reverse exercise. This time the selling security, okay? So dropped, and currency dropped, and you buy from the use the currency. So that's why in your balance sheet is your buying the security. This is the Fed selling, okay? So that's why your money reduced. So if they do all the way, they find out that the economic system of money will drop, okay? So same thing again, currency dropped means the monetary base dropped, okay? So reserve didn't affect it. So that's the whole point affected, okay? About affect to reserve or affect monetary base, okay? So now let's see this one. This is a little complicated, okay? So from deposit into currency, okay? So let's see how that works. Imagine that. So we did this one, right? Already say, okay, see this banking now, before it's reserve, okay, in the banking. So now you remember you already use your check. Right now you have the currency and then you withdraw the check and then you have the cash. So that's why you can see you increased, okay? You increase this one. So what happened to here? Banking system, okay? So once see the banking reserve dropped because you withdraw the check. Once you withdraw the check and the reserve will drop this in banking system, okay? So what happened to the Fed? This is just because your action. And then what happened to the Fed? Fed, it is what? Currency increased 100 million. all right, and reserve increased 100 million. Okay, this is because you take the action like this way. Okay, you use a check, so you shifted from deposit into the currency, so that you will be, before, remember, you use the money to buy the security, and now you use go to that deposit your check. So no banking system checking withdrawal, and then you got a currency, and then banking will have trouble withdraw. So this lower, okay? And then Fed system becoming, because you can see check deposit, it is dropped. And then remember we said reserve will be dropped that way. So that's the banking system, and the Fed, because the Fed created situation, okay? So that's the Fed increase the currency circulation, increase the reserve becoming dropped because the banking dropped reserve here. Okay, so 3 players balance put in here showing you how this affect to the monetary base. Okay, only because currency and this is reserve. So overall monetary base didn't affect because the monetary base inside the currency plus reserve. Net result of monetary base didn't happen, didn't affect it. So whole point is trying to tell you focus on monetary base much better, because currency and reserve could be interchanged between each other, but the monetary base consistent of the Fed purpose. Okay, so here trying to showing that. So just say what could be, okay, what happened. Let's see next one. Now Fed loan to institution. Now this is becoming second tool, okay, monetary policy tool. Before the open market operation, can buy, can sell, can reverse everything they can do. Open market, this is security selling, buy, okay. This time is the Fed have a discount window. They make a loan only to their member. They can, remember, I keep mentioning about this. They cannot lending to Lehman Brothers. They cannot lending to investment banking at that moment. The rule regulation set up that way. So only can lend to member bank. So discount, this is discount window. This is normally called discount the loan, okay? So loan to financial institution. So you had a member qualified to borrow from the Fed. Not everybody can borrow. You think about global, let's say Greece, they have a default before. They say, okay, I'm default. Why don't borrow money from US Fed? They're not qualified. They can, okay? So this time borrow, now let's see. So Fed make a loan, okay? Fed make a loan, so Fed loan increase 100 million, okay? So lending to member bank, okay? So when Fed make a loans, so asset increase, they created, okay? They're lending to the banking, so create this 100 million. And then you can see it's increase liability because banking get this money, okay? Liability increase 100 million. So banking, look, this is bank borrow, right? Just if one bank, you can see liability is they borrow the money loan. Remember loan you see it's like assets, but this time it's they borrowed. So that's why it's liability, okay? So that's increased 100 million. So, but bank borrow the loan, but bank have money now. So it is reserve, okay? So very important here, let me mention, because you're gonna be, you're gonna see here is, I make this too many here, okay? Because you will see why, okay? In the beginning, whatever they do, this piece, the loan piece here, this is in the beginning, whenever they do buy and selling assets or make a loan to the JP Morgan, whatever it is, every in the beginning money, because let's have account with the Fed. The Fed and the JP Morgan do everything business. First step is just parking here, the money is reserve, okay? Then JP Morgan have right, can do anything they lending, but in the beginning is reserve just here. Even the JP Morgan want to sell, buy, is at this point is reserve. But later on you will see change it, okay? But now you just see whatever happened is reserve right now, okay? So that's why that moment you see it's reserve. Okay, so borrow money now, okay? So now banking have the loan, they borrow money, so that's why they have the money, okay? So that's why at this point it's reserve, okay? So money, this whole thing they borrow, it is Fed lending to the banking. So money liabilities, which is, remember the Fed, this is called like money liabilities, also called the monetary base, right? So the Fed have increased by 100 million, okay, this piece. So money base also increased because your reserve increased this piece. When you talk about monetary base is this piece. It's monetary liability, also called monetary base, also called high power money is here, okay, so increased. So they trying to give you direction about what's going on. And I think you very soon can see, I don't want to talk about this because this very soon I will touch. Next one I will touch about this one because this is 3 pieces. Each one is definition. The definition not big deal. Key point is once we know this scenario about the reserve and monetary base, then we will see how the mushroom growing. That's the whole point I want to talk about. But later, okay, not rushing. I don't want rushing because here's just too many puzzle here. That's why I want to. Because so many balances things. That's why I want to slow a little bit. But then next one we'll talk about, this is a small piece. After this, the rest is very, very important. Okay, this is just, I will touch about these definitions. So we might say about next time we stop here because this, like I said, this chapter is very important. I don't want to just keep looping. Okay, keep looping become trouble. So we stop here and next time we'll be pick up from here. Then I don't think we can finish this chapter for this week. I want to slow this piece, okay? So any question here? And like I mentioned about homework is opening. You do homework help you to understand those check balance, right? Understand this piece. Like I said, this chapter is important and it's not really easy because it's looping a little bit, but you will see the point. Very soon you will see the point in this chapter. And then next chapter is also very important piece, is key, okay? And that's it. Any question? All right, so that's it.